Hello and welcome to Wrestling with Real Estate, where we love to chokeslam all your real estate problems. I'm your host, former WWE wrestler and now Cirque du Soleil performer, and of course, multifamily real estate investor Barri Griffiths. Now today we're joined by Rob Beardsley. Hey Rob, how are you doing, man?
I'm doing great. Thanks for having me on the show.
Yeah, I'm very excited to have you on the show, man. And for people who can't see, who just listen to the podcast, Rob is in New York and he has a really cool background when I'm looking at it in Zoom. So you got a really cool place there, man. It looks awesome.
Yeah, thank you so much.
So Rob, for people who don't know about you and for listeners who are listening to you maybe for the first time, can you give maybe a quick update about who you are and what you've been up to?
Yeah, absolutely. So I'm the founder of Lone Star Capital. We're a multifamily owner operator focused on Texas workforce housing. We, we look for underperforming properties that need renovations, improved management, and potentially a change in capital structure, something like that. And prior to forming Lone Star with my business partner, I grew up in Silicon Valley in California in a real estate family. My parents ran a residential brokerage firm, so I was involved on the single family side in terms of the on sales, construction, development, fix and flip, and before myself and my family transitioned to multifamily about 5 years ago.
Oh, very cool, very cool. So it's in your blood, I guess. It's in you grew up around it, right? But interestingly enough, I find that sometimes when you grow up around it, it's not always kids don't always want to do what their parents do, right? And it's that's something I have a 20-month-old son and I'd love for him to be involved in real estate. And I'm always wondering, how do I get him involved in real estate without pushing him too much? Did your parents push you into it? How did they get you involved? Did they just have you do a little bit here and there?
Well, it was almost the opposite, because growing up in Silicon Valley, everything was about tech.
Yeah.
There's the startups, there's the big tech firms, and so that was where all the money was, and that was where all the all the excitement was. And so my parents, looked at their situation and felt that they were working really hard, and it wasn't paying off the way they wanted it, and they said that, they would encourage me to go focus on getting a career in tech, because they thought that's where the big bucks were. That's where I would be successful. And it's not that they're wrong, but just for me, it ended up, I went to school for computer science, but I ended up circling back to real estate just because I felt it was a more tangible entrepreneurial path for me to take. And in a way, it was in contrast to my parents' business, because on the single family side, they were very transactional based. It was, a lot of clients, a lot of deals, working at all times of the day and night. And I didn't like that. I saw them being very stressed out. And in my own way, I wanted to build more of a true business, a system, and build assets and build wealth. And I found that multifamily, as you understand, is far more conducive to building that sort of business and wealth than something more transactional like single family sales.
Yeah. So how did you get started? Did you just go work in the family business or did you go off on your own? How do you first get started in real estate?
Well, in terms of multifamily, I just started with doing a lot of research, networking, and getting really immersed into the industry. And then once I kind of got my foot in the door, I started dragging my parents into it as well, saying, "Hey, this is where we need to be. This is where we need to go." And they're very busy in their day job, so it's hard for them to kind of take their eye off the ball. But I just drug them in a little bit, got them some exposure, and because they have all the experience and the relationships, they were able to help me tremendously launch in that new field, even though it wasn't exactly what they were doing. So that was a really powerful and fortunate way for me to be able to get started. And then as I was proving out the model, we were able to transition more and more to multifamily, and then essentially go full time into that, away from the residential business.
Oh, very cool. So your parents are fully involved in your multifamily now. They don't do the fix and flips. They're just involved in. Oh, very cool.
Yep.
I'm sure it's beneficial. I'm sure they're glad that you brought them to multifamily.
Yeah. Hopefully, it was a little scary at first, because what if it's a mistake? and it's all my fault, right? But
Yeah.
so far it's been working out well.
Very cool, very cool. So what was your guys' first deal? What was the first deal that you did in multifamily?
So the first deal we did was really just taking a dip in the water by way of raising capital. So we understood real estate, we understood the numbers, but we didn't really have the deals, we didn't really have the operational expertise, and so we partnered up with somebody who already essentially closed on the property and was looking for equity to recap the deal. And so, we evaluated the deal, we felt comfortable with it, so we invested in it, and also went to our network of clients back in California, and we raised the capital just overnight and closed that deal. And then that was kind of our experience of seeing how a deal works, from the transaction, the capital raising process, the operations, and things like that. And then moving forward, that gave us the confidence to then take the big leap into actually securing our own deal and going through the entire process all on our own. And obviously, when I say on our own, I just mean the buck stops with you. At the end of the day, real estate is always a team sport. So it wasn't anything we did on our own, but it was just a situation where, all the stress and all the responsibility ends up on you. You have to make it happen. You have to raise the money. You have to secure the debt. You have to, when you're starting out, you need a loan cosigner to qualify for the debt. You need a property management partner. And so putting all that together, it's all that responsibility is on you.
Yeah. But starting out, that seems like a great way, right? I hear a lot of people, that's how they start out. They partner with someone else because, like you said, it is a team sport. But as if you're the sole GP, there's a lot that goes into it, right? You leverage other people's skills and other people's abilities, but ultimately it's your job to pull everyone together. And there's a lot that goes into it. It's not just a case of finding the deal and closing on it, right? There's so many moving parts that goes into that maybe people don't realize. So when you're starting out, that can be a little bit intimidating and a lot to learn. You don't know what you don't know to start off with. But by partnering with someone who has that experience, you like you guys did, you guys brought the capital, you used your skills at that point, you had a great network of people that you knew from California and were able to bring the capital in, and then leverage the operator's experience, learn from them, see what they did, and then that gave you the confidence, I'm sure, to then go on to do the next deal.
Yeah, exactly. I think it's like you said, a terrific way to get started, and it's a big shortcut because you could definitely do it on your own, but it's just going to take longer. And it's well worth it. Whatever you think that you might be giving up by being a partner, in a partnership, it's well worth it.
Well, and how do you create that relationship? Because it's one thing to say, hey, yes, let's partner with someone, but it's not like every operator or every GP is just going to take anyone on, right? It's you've got to somehow get your foot in the door. How were you guys able to create that relationship to be involved in that first deal?
Yeah. So, like I mentioned to you early on, it was all about information, learning, and then the other big component was networking, and still is. It always will be. And so, getting involved in meetup groups, in physical meetup groups, online groups, masterminds, mentorship groups. So attacking all those angles and building those relationships through those avenues was the way that we were able to build those relationships. And we still have many of those relationships to this day and continue to look to build new ones.
That's awesome. That's awesome. Yeah, because it's like you said, it really is a people business, right? The more people you can meet and create relationships and go to these educational meetings and meetups and masterminds, because you're not only meeting people, but you're learning and you're getting more experience just from learning from these people and being around these people as well at the same time. So I think for anyone looking to get started, that's a great piece of advice. But tell me a little bit more about the first deal that you guys did by yourself. Where was it? What was the size of the deal? What was the business plan? What was the raise? What was the purchase price? All that good stuff.
Yeah, sure. So it's a 260 unit multifamily property in Texas, Houston specifically. It was a very rough deal. Were we were fortunate in finding it, and we were fortunate to be a little naive to be willing to take on such a big deal. Looking back on it, I look back and think, wow, I can't believe that I had the guts to take on such a project, because today I would who knows what I would think about it. So I'm very glad we did, and it's worked out. But definitely a big project at the time from many perspectives. Obviously, it's a large project, 260 units. We had to raise $4.5 million. We the, the business plan was very deep value add, opportunistic, where the current owner bought the property in a pool in a foreclosure portfolio. So it was in really rough shape. The owner just did a kind of a quick touch up on it, filled it up with some really low quality tenants, and then just passed it along. And so we knew we had a lot of work to do on it, but we didn't realize how much work. We thought we had an understanding, and that was one of my first big lessons on that project, was understanding that if you are going to get involved in a deep reposition like that, you have to anticipate major turnover at the property and a dip in occupancy. And so that's exactly what happened. We ran the occupancy down to 70% and had to essentially turn the entire rent roll over. Every tenant that we inherited from the seller, we pretty much, they either skipped and left because they saw there's a new owner in town, and we're finding people for litter and things like that, and or we had to make evictions due to non-payment and all that. So we pretty much lost all the tenants that we had inherited and had to bring in new tenants and lease back up. And so that's obviously a longer process than anticipated. So that was a deep value add where we were learning a lot of lessons. But that's what our first deal looked like. And so we purchased it for $15.4 million and invested about $2 million into it in renovations, both on the exterior and the interior. And then we refied we went in on a bridge loan and then made the improvements, stabilized the asset, and then refied at a $21.5 million valuation and had some cash out proceeds on the refi.
Wow. You obviously were then able to pay your investors back. How much of your investors' capital were you able to pay back on that refi? Majority of it, or?
No, only about 25%.
Okay, but that's nice then for the investors, that they get some of that capital back and they're still involved in the deal. So, but that's incredible, right? The first deal, 260 units by itself is a very large deal, right, for most people, especially the first deal. But to have something at a heavy value add is incredible. So congratulations on that. Roughly what were you guys spending per unit, do you think, on renovating?
About $6,000.
Okay, spread over 260 units. That's very capex heavy. But how long ago was that? Do you guys still own that property? Is that still part of your portfolio?
Yeah, we still own it. We bought that property, I think, coming on 3 years ago.
Okay. I'm sure it's gone up in Texas. I'm sure it's gone up in value just a tad since then. And since then, what does your portfolio look like now? How much have you grown your portfolio since then?
So to date, we've acquired over 1,500 units. Mostly ourselves, some in partnership with other sponsors in locations outside of Texas. For example, we partnered on a deal in Jacksonville. We partnered on a deal in Vegas, actually. So yeah, Vegas is a great market. So yeah, we've definitely are looking to continue to build the portfolio up. Hopefully also make some sales, because it's important to go round trip. I think just kind of some important piece of advice that I don't really hear people say, and it's hard to kind of know all this up front, but it's very strategic. And I think if you can help it, don't buy a deep value add as your first deal. I don't regret it. It was an off-market deal that came to us because we were, pushing and looking at a particular area and chasing deals and whatnot. And it was a good deal. But if you can plan it out perfectly, don't have your first deal be a deep value add, because it's just it's a longer period of time to show the progress to investors. If you can buy a nice in-place cash flow deal and just start, clipping monthly distributions right away, as a sponsor, that's going to really look good to your investors right away. They'll feel comfortable. And, when you're going back to do your next deal, you'll be likely able to raise more money and build off that momentum. Whereas on the inverse, if you are not making distributions and you're working on all this construction, your investors are more likely to be patient with you and say, oh, I'm going to wait and see how this deal goes before moving on. So that was one idea. And then the second one is, I think it's if you're a sponsor looking to build your experience as quickly as possible, you need to sell something. And because by selling, then you can show that, buy, manage, and sell experience, which is important to a lot of investors to see. So yeah, that is some important things. So that's what we're looking to do. Continue to build the portfolio, obviously, but also make some sales so we can build up our track record.
Yeah, because that's a good point. Because investors, they want to see your track record, and if you have a heavy value add property, you haven't made any distribution, so you don't really have a track record at that point. It might be a great deal, and it might, on the back end, it might be a phenomenal deal. But at that point, investors want to see a track record. They want to understand what you've done, how you've done it, how successful you've been. And that's another reason why it's good to go full cycle, right, on the deal, because then they've seen, okay, this is the proven results that you've done on this deal. This is what the investors got. This is how it all worked out. And they feel comfortable because investors, understandably, right, they have this capital, but they want to protect it. They want to make sure that they're investing their capital with the right sponsors in the right deal that's going to protect them and give them the returns that they hope for.
Yeah, exactly. It's investors' number one language is dollars.
Yeah. Going back to that first deal, and this will lead me to the subject we're going to talk about, is the financing on that first deal. You mentioned there was you had to get co-sponsors on it, right? And the reason is because when you're getting debt in commercial real estate, they look for net worth and liquidity in terms of equal or greater to the loan amount, right? And I'm guessing starting out, when you're doing a $15 million deal, you might not have that, right? So you need to bring on someone who does, and they'll sign on the loan. Was that a challenge finding someone to come sign on the loan with you guys, to kind of partner with you guys a little bit on that? How did you guys find a co-sponsor? Was it networking again?
Yeah, it was a very big challenge, and it was something that we were ill prepared for. And that's another lesson that we learned. And there's nothing stopping you from building relationships with a co-signer and kind of locking in that arrangement before the deal, right? So the mistake is, and this is something that my dad would always say, even on the residential side of just simply buying a home, is time moves very slowly when you're not in contract. And then the second you go under contract, all of a sudden time moves really fast. And so everything that you can do before going under contract, don't wait, get that done, because it's not going to be, it's one more thing that you don't have to worry about while under contract. So that was, a mistake we made. We kind of just walked into the deal thinking, well, maybe we can find a lender who will waive the requirements, or, we just weren't preparing well. And what that led to was the need to scramble and kind of try to quickly build these relationships. And so people see you as vulnerable in that situation. And so you don't want to do that. If they see that you're up against the clock and you have a deal going, and they can take advantage of you. So it was difficult for us. And like you said, it, of course, you have to network and go out there and find the right people. But if you don't have the luxury of time and you can't be patient, then you can't be selective, and you kind of just have to take who you can. And so we tried out a couple options and started negotiating, saw that it didn't work. And then we, ended up landing on a couple co-sponsors. And so it's, it finally worked out. And like you said, when you're first starting out, it's unlikely that you can satisfy those requirements. And even if you have net worth or liquidity, it's often an experience barrier as well. They want to see someone who on the team who has multifamily experience. So it is a big hurdle, 99% of first time sponsors. And so very thankful now that we don't have to deal with that. It's a really big blessing to be able to take deals down without co-sponsors. But yeah, when you need them, you need to prepare.
Yeah, absolutely. Someone told me that a long time ago, and I don't think it's something that's talked about often enough, actually, is that you should always be looking at networking with co-sponsors, right? Key principals, people who can help you sign on the loan, who can satisfy those requirements that the banks need, because you need that, right? You need the experience, and you need some. And so if you have a pool of people, and even if you have one, say for example, well, they might be tied up with another deal. They might not like the deal that you're doing. If you want to have a pool of these people that you constantly networking, constantly talking to, and constantly building those relationships. So when you have deals, like you said, you don't want to be going in there trying to find them once you're under contract, because you're, like you said, you're vulnerable. And the reason that's not good for many reasons is that the key sponsors get a share of the pie, right? They get a percentage of the deal. And if you're coming from a place of weakness rather than strength, they can negotiate a bigger piece of the pie. And we're all doing this to benefit ourselves financially, right? So if you're giving away more and more of the deal, well, it doesn't help you. So I think that's a great point that it isn't talked about enough. You should always be looking as a multifamily syndicates are looking for key principles. Now, it's great that you guys are at a point now where you don't necessarily need that, right? So that gives you guys a lot more freedom and it helps you keep more on the pie. So congratulations on that. That's a great place to be. But on that point, on the financing point, we talked off air before this that we would kind of jump into a little bit of financing, because financing is such an important part of multifamily, right? Financing, getting the right financing on a deal can make or break, right? You get the terms and interest rate and the type of loan that you get on the deal makes a huge difference on it. To people who maybe aren't familiar with commercial financing, do you want to give maybe a quick breakdown of what's the difference between commercial and residential financing?
Yeah, absolutely. And just to finish our co-signing point,
Yeah.
like I described, we learned the hard way,
Yeah.
and we totally understand it. And so now that we're in this position, able to sign our own loans, now we act as a co-signer for other sponsors. And because we learned the hard way, we're not looking to take advantage. We're not looking to take it, see somebody who's weak and under contract. So, we have our terms, and if it's a partnership that they're comfortable with and we're comfortable with, then we just go for it. So yeah, co-signing is something that we're interested in. So if anybody's listening, feel free to reach out to see if we're a good fit. But yeah, to jump onto the debt side, on the commercial side, kind of one of the biggest differences, like we've already discussed, is really the requirements of the net worth, liquidity, and experience. And so that's a major hurdle to overcome on the debt side. And then, like you said, since debt plays such a large role because it's the majority of the capital structure, and real estate is 99% of the time leveraged, and you have to have the right leverage for the deal to make it work, to win the deal, and to actually match the business plan. And so some of the key elements for us when we're looking at a deal and evaluating the debt is we're looking at kind of like what I mentioned, to match the business plan. So if we want to have the flexibility of being able to sell early or to hang on to it for a longer period of time, we're going to want a more flexible prepayment penalty. And that's when people first get into the business, they think the two most important things of debt is the leverage, the more the merrier, and the interest rate, the lower the better. And to some extent that is true, but the prepayment penalty, I think as you get more experience, you realize how important the prepayment penalty is. And um, locking yourself into a 10-year loan with onerous yield maintenance can really be out of alignment with your business strategy if you plan on selling in 3 years, for example, which many people do. So you just want to be aware of that. And the two main types, at least in our business, in the multifamily business, the main types of debt are permanent debt and then bridge loans. On the permanent side, you've got the juggernauts, Fannie Mae and Freddie Mac, and that's really just the best debt because they're government sponsored enterprises, and it's government backed debt. So you got the cheapest rates, best terms, especially when you're talking about like affordable housing, workforce housing, which is what we play in. And that's where the government is very aggressive and wants to give you the best terms possible because they want to provide liquidity and preserve affordable housing. So on the permanent side, that's really the main players. And then on the bridge loan side, that's for deals that are in a transition. So maybe deals that don't have strong occupancy, or they need just a ton of work, like roof replacements or mold issues or down units and things like that. That really disqualify or not make it a good fit for permanent debt. And then economically, the two main factors between the two is how they're underwritten. And this is a really important point, especially today, because cap rates are low and valuations are very tight, a permanent lender like Fannie Mae and Freddie Mac have to underwrite and basically determine the loan based on the in-place numbers. They have to look at the in-place revenue. They can kind of play around with the expense side a little bit, but they're pretty much stuck looking at the in-place revenue. They can't look to the future. So if you have some big grand business plan of I'm going to double rents and I'm going to increase this and do that, it, it's going to fall in deaf ears on the permanent side. But on the bridge side, the lender's acting much more like a partner. And for the deal where you do have a business plan that's more involved and more transitional, like even for example, if you're going to take a hotel and turn it into multifamily, or an office building into multifamily, that's another way of transition, and that would be a bridge loan as well. So that's where the lender isn't looking just at your in-place cash flow, but they're actually looking at your business plan, and they have to buy into your pro forma to make the loan. So those are the main characteristics and differences between the two main types of debt.
Yeah, and when they're looking on long-term debt, the Fannie Mae, the Freddie Mac, what are they underwriting? What are they looking for? What is important to them when they're looking, like you said, it's true, they're looking at the in-place numbers. What is important to them? What would make them say, I'm going to do this deal or I'm not going to do this deal?
So they're the two main constraints in terms of leverage are LTV, which is loan to value. So they're looking at, okay, what is the value of the property? And the way they're coming up to value is a combination of evaluating the income and having that income be supported on an appraisal, and then basically you have your underwritten / appraised value, and then you can make a loan based on that value, LTV. But the other constraint is directly to the income itself. And so mostly what you see standard is a debt service coverage ratio of 1.25. And what that simply means is that they need to see your income be 125% of the amortized debt service. And so that may sound a little bit complicated, but this is actually one of the most important things that has made multifamily such a smart and safe investment. Because if you look back going to the global financial crisis, which at the core of it was risky lending based on ever increasing values that were not tied to income, that was happening and that was on the residential side, that was happening because there was no correlation between how much a lender was willing to loan versus how much income the property produced. So the fundamentals were way out of whack. But on multifamily, and even back then as well, multifamily lending has remained tied to the income. So valuations can get tight, but they can never be stretched beyond the fundamentals. And so that's what's keeping valuations. I mean, yeah, people think prices are high, and they are, but they're staying within reason. And that is really because of lenders being smart. Because like, I forget who says this, but look at every bubble, and at the center of it is a lender, right? And so lenders are actually, for the most part, really careful in the multifamily business. And so that's what keeps valuations sane, safe, and keeps the business moving. So that debt service coverage ratio of 1.25 is a really important number for them.
Yeah, and I think that's why you don't see very much defaults in multifamily, right? Because for one, it's a great business, and it's the old adage, everyone needs a place to live, blah, blah, blah. But also, like you said, the underwriting from the banks helps protect them. They have that buffer, right? They're not at, the loan is 100% of the income, right? Of what they, there is some, there's a delta there that protects them. And I think, like you said, that really does help keep multifamily in line with that. Now, obviously, prices have gone up, cap rates have compressed, but at the same time, that delta there between the income and the debt coverage ratio, gives a buffer and helps protect that. That was interesting. What have you seen, and what are you continuing to see with Fannie Mae and Freddie Mac because of COVID, right? What kind of reserves have they slowed down with their reserves? What does that look like? How has that changed the lending environment?
Yeah. So for those who are less familiar with the goings on of Fannie Mae and Freddie Mac in the multifamily debt space, when COVID hit, it was a really fascinating time because here you have government sponsored enterprises that is their mission to provide capital to this space. But yet, at the start of COVID, we had such great uncertainty. Are tenants able to pay their rent? Will they be able to pay their rent? Are they going to be willing to pay their rent? And so there was just so much uncertainty that a lender, it was very difficult for a lender to make a new loan, because what assumptions can they make? Can they even rely on the historical income as a justification for future income, right? At least over the next maybe 12, 24 months. And so, in my opinion, the agencies, Fannie and Freddie, did something that was brilliant, actually, and they implemented the famous COVID reserves. And so everybody hates them because it just requires you to bring more cash to the table. But it's a genius way for them to be able to continue to provide making loans during that period. So, and while all these other lenders shut down, Fannie Mae and Freddie Mac just kept on able to do deals and continue to produce loans. And so it was in part because they had that confidence by implementing that COVID reserve, where they were holding back, early on, they were holding back, $1 million plus, to ensure that if you can't, or if the property can't pay the debt, well, they've got that big COVID reserve that's going to step in and make those payments. And so, if you kind of modeled in a worst case scenario, the COVID reserves that they were, taking in could maybe keep the property supported for, 12 months, 24 months, 36 months. So it was a long runway that they were building in. And that I thought was brilliant. And so now here we are today, June 2021, the COVID reserves from both Fannie and Freddie are completely gone. So they've really let up, and they've opened up and said, all right, we're comfortable. And, they're making loans, much like they used to. The other thing that changed, it appears to be short term during COVID, was, they generally pulled back leverage as well. And if they were in a market lending 80% before, now then they were lending 75. And now it seems like it's picked up a little bit, especially the major change in the capital markets is the decline in interest rates. We've all seen that. We've seen the short-term rates go down to zero, and the long-term rates went really low, and now they've since tripled, but they're still very low. And so what that means is that when the interest rates are lower, the debt service coverage ratio is it goes up, because if your debt is cheaper, well, you only need so much income to cover that debt at the 1.25 ratio. So that allowed them to kind of push on leverage again and get back to where they were before, even if, let's say, cash flows were down a little bit due to COVID, which most of the time, if you looked all around the country, cash flows were down because of lower occupancy or lower collections and things like that. So yeah, those are some of the really interesting things that went on during COVID.
Yeah, but interestingly, I'm sure the release of not having to have the COVID reserves, that makes a difference when you're underwriting deals, right? So I'm sure this helped push pricing again, right? The LTV has helped push pricing again. Just the release of all this has helped push prices down, up even more, and cap rates down even more, right? And it makes it even more challenging to find deals, I'm sure. But it's at the same time, it's it's a great lending environment right now, right? I think in terms of cap rate, in terms of interest rates, what kind of interest rates are you guys looking at on a lot of deals, just for people who have interest in that?
Yeah. So what is really interesting is pre-COVID, we had a very flat to inverted yield curve. And so for those that aren't familiar, the yield curve is typically in reference to the relationship between, essentially just short-term interest rates and long-term interest rates. And a steep curve would mean that short-term interest rates are low and long are high, and you've got a steepness there. And then typically when you're at the top of the cycle and prices are high and this and that, the yield curve flattens. And basically a short-term interest rate costs the same as a long-term interest rate. And that doesn't really make any sense, because usually if a lender is going to be willing to pay or to make a loan for a longer period of time, they're going to want some premium for that. It's called term premium for making a longer term loan. And when the yield curve is flat, that basically means lenders don't, I'm sorry, how does this even work? Lenders want to make long-term loans more so than short-term loans. So they're willing to accept even less interest on a long-term basis than on a short-term basis. And so that is a weird phenomenon. And it usually means that in the short term, things may not be, like, we might be heading into a recession, right? Typically the yield curve inverting, which means short goes higher than low, or short term goes higher than long term, it's an indicator of recession. And so that's kind of where we were before COVID. And so with that, it really made sense to lock in long term interest rates because they're the same price as short term interest rates. So we might as well lock in the longer term, even especially when they inverted, because then it was cheaper. But then with COVID, it went back to normal, and normal meaning a steep yield curve, but it's not normal because we haven't seen it in a long time. But it's a healthier market for that to occur. So today we have got pretty much 0% short-term interest rates, and then around 1.5% long-term interest rates, which is, both rates are very low, but that's pretty steep. So with that being said, you can borrow long-term fixed rate money at around 3.25, 3.5%. And then on the short term rates, we're doing a deal right now where we're borrowing at less than 2.5% on the short term rate basis. So it's really interesting to see that dynamic today.
Yeah, that's those rates are incredible. It's hard to believe that rates are so low, which is great. When you're buying multifamily, and, when you lock in a rate for a long period of time at 3.25, that's just such a great rate, right? It's such a that the debt in itself is an asset, right? When you're able to get it for that cheap. So that's good. And thank you for explaining that as well. And essentially what it comes down to is that when the yield curve inverts, people don't feel comfortable with what's happening now, right? They're scared of what's going to happen in the immediate future, and they feel more comfortable with what's going to happen in the long term. That's why those rates they invert. But you did a great job of explaining. Much better than
thank
I.
you for that. I had to give myself an economics lesson just now.
You did a 10 times better job than I could ever have explained that. But yeah. Well, Rob, hey man, this has been such an interesting interview, man. Thank you so much for taking the time. Done so much in 3 years' time to build a portfolio of 1,500 units is incredible, and obviously, there's a lot more to come from that, I'm sure. So, and thanks for taking the time to explain so much stuff today. It's been a really, really interesting interview. But as this show is called Wrestling with Real Estate, I like to incorporate some wrestling-related real estate question. And the first question is, what would your wrestling name be?
Well, I haven't been able to think much about it, and this is going to be very corny. But you mentioned Undertaker earlier, yeah. So people know me as the Underwriter a lot. So I'll probably go with Rob the Underwriter.
I like that. No, that's cool. That's perfect for multifamily. So every wrestler has a special move. What is your special move in real estate?
So my special move is I really love the complex. And as you maybe could see, I started rambling, talking about some interesting topics, and hopefully I did an okay job of explaining it, because I do believe that is my special power, where I like to take complex topics and break them down and explain them simply. And the reason why that's a special power is it comes in handy a lot, especially when we're talking to investors and explaining deals. The more simply you can explain something, the more success you're going to have, in selling it.
Yeah. No, you did a great job, no doubt about it. And like you said, real estate is simple but complex, right? I always say that the basis of it is very simple, right? You buy a big property, you rent it out, you get the income, and you share that income with investors, right? But then there's a lot of complexities that go into that. And if you're able to take those complexities and make them simple and have investors understand them, they're going to feel a lot more comfortable investing. So that's definitely a great special move to have. What's been the biggest body slam you've taken in your real estate career?
So I would say we were sharing that story earlier about cosigners. I would say that was a pretty big body slam, because it took us some serious trial and error to end up in the arms of the right cosigners. And so getting burned, kind of 1.5 times taught us some good lessons. And I think some classic lessons that apply to all business and relationships of just, you might be an honest person, but the person you're dealing with might not be an honest person. And sometimes, maybe you do your homework and you end up being wrong still about your judgment about people. So I think, that is such a tough thing to get right. But when you do, hang on to it, because those relationships are so valuable.
Yeah, absolutely. So was there a moment that you were standing on the top rope, getting ready to jump, but you were too scared? What was it, and how did you overcome it?
Oh man, I'm trying to think of being too scared. I've you heard the story of how we just jumped into the $4.5 million raise. That was crazy. And because we were kind of naive, we just kind of went for it. And so we didn't have enough fear, which in that sense, it was good to not have fear. But I think in other cases, it's good to have fear because you need to be smart with your judgment and decide, okay, is this something that we should really take the risk on and whatnot? Because, for those that aren't familiar, you don't just sign up to raise money and then you're good to go. When you buy these deals, you have to put them under contract and you have to put often non-refundable money down to even have the chance to buy the asset. So for example, right now we're under contract on a property and we had to put up $250,000 immediately non-refundable just to have a chance to inspect the property and put a package together and share it with our investors to to hope that we can raise the money and hope that we actually like the deal and want to close it. So there is a lot of risk there. And I think uh, I think fortunately early on didn't have the fear to on the standing on the top rope, but now I've kind of built up that fear in a way of just being kind of smart and patient and making sure that we're making the right decisions.
Yeah, yeah, very cool, very cool. All right, man. Like I said, thank you, man. This has been a really awesome interview. Love this interview. Really enjoyed it. But for people who are listening, who want to find out more about what you've got going on, what maybe possible deals they're interested on, just speaking to you on a personal level, how can they get in touch? How can they find you?
Yeah, so to learn more about us and what we're up to at Lone Star Capital, head over to our website. That's lscre.com. That just stands for Lone Star Capital Real Estate.com. On our website, you can get in touch with us through our investor form. You can download our free underwriting model that we use to evaluate deals every day. If you yourself want to underwrite deals, which I urge everybody to do so, whether you're a passive or active investor, obviously underwriting is key. So definitely check that out. And feel free to reach out.
Very cool, very cool. Well, thank you so much, man, for making the time, and have an awesome rest of your day there in New York.
Thanks, you too.